course of the month, we had a number of publications. My schedule was a bit tight this month. Not all the content were totally published, but I promised that as soon as we finish the conversation today, the ones that have not been published, I will approve their publication. So as usual, our publication covers 4 different areas. Right. From time to time, I might need to confirm from you if you can hear me. My location today, the network there is not too stable. So please confirm if you can still hear me.
Yes, we can, sir.
Okay, good. So in the course of the month, we published something on auditing as usual. This time we published ISA 540. Which is auditing, accounting estimates, and related disclosures. Please bear in mind for our new joiners, this social media engagement it's pioneered by KCP, and our intention is to drive public enlightenment and professional competence among existing professionals and new joiners into the profession. So as much as possible on what we are discussing today, if you have additions that you wish to or contributions you want to make to it, please feel free. It is not expected that we should take this alone, but we should rub on each other at various professional prowess. I hope I will have your cooperation on this. So back to this, on auditing, we did publish it's a 540 auditing, accounting estimates, and related disclosures. For the auditors in the house, you will agree with me that this is a very sensitive aspect of the audit process. Financial statement prepared by various organizations are to a very large extent subject to a number of accounting estimates. To what extent will this or could this have impact on our audit process? We'll deliberate on that today, and what is expected of us as auditors while carrying out our various audit engagements. Aside that, we also look at or schedule for the month and another very interesting aspect of tax practice intertwined with financial reporting, which we call IAS 12, accounting for income taxes. There has been several debates whether this should be the responsibility of a tax accountant or that of a financial accountant. Whether done by a tax accountant or an accountant, it is very essential that this be done. So we'll be reviewing a number of salient issues around income tax, what is expected of you, what are the components of this, how should we make these provisions, and what effect it does have on financial statements when it is prepared. Please confirm if you can still hear me. I have to be engaging with you from time to time to be sure that we are still together. Awesome. Thank you for the thumbs up. All right. The third aspect of what we will be looking at today is what we tag. It's part of the HR practice. What we tag the dark side of office politics. Should we actually encourage politics or politicking in the office or in the formal environment at all? When it finds its way in any environment, what could be the bad side of it? We'll be highlighting how to managing this in the course of our presentation today. And lastly, on financial reporting, we will be briefly discussing about IFRS 18, one of the most recent standard newly introduced. What expectation has the standard of us? What do we know about it? what should we know about it? How should we apply this? All these areas are part of what we'll be looking at today. Once again, I want to welcome you all. I hope you have your pen and you have your paper, penning down every information of value to you, and also feel free to asking your questions where necessary, or indicates that you want to make some contributions. All right, so joining me in anchoring this deliberation today, some of my professional colleagues here. I have Kozim, I have Adeleke, I have Alex, and I have Oluwagbogbo. Maybe in a subsequent engagement, we probably will be throwing these hot seats also to not necessarily staff of KCP. We could give our audience to the opportunity to sit on the hot seat and see how warm the seat is. Bogo, do you mind me to start with you today? Bogo, are you there?
Yes, sir. Good evening, sir.
Good evening. How are you today?
I'm fine, sir.
Yeah. Let's start with your topic, the dark side of office politics. What is office politics itself?
Okay, so once again, good evening, everybody, and good evening again. So when we talk about office politics, we can say office politics is the activities or interactions among employees in an organization that aim at gaining power. It is just like a power play between two or more employees. When we say politics, we all know what politics is. Politics is when you are trying to gain power from one another. But when we talk about office politics, you are trying to influence the decision in your workplace.
Really? Really? Why would anybody be interested in that? Knowing fully well that you have come into, or you have joined the company of your interest just to earn your pay and do your work. Why do you think that should be of interest to any?
Okay, so there are many reasons why people play politics at work. So one of the reasons now is forming alliance. You want to be at the upper echelon of your workplace. So for example, now you want to be in the good book of your employers. You want them to know, oh, this person is the one working, this person is the one doing everything. So you try to go with the faction of people that know they have the power to show everything to the boss, that, oh boss, these are the people that are working, these are the people that are not working. So you try to play to your advantage.
But how do we strike a balance between, or strike the difference between a very dedicated team or member of a team doing his or her work innocently with no intention, and in comparison with those who deceitfully trying to gain attention? How do you identify which one is which amongst them?
Okay, thank you very much, sir. So just like you said, the difference now is when you are working innocently, you are doing this without any bias or you have any ulterior motive in you. But when you are trying to play office politics, you are doing this with the aim of gaining power. You are doing this for eye service. For example, maybe when your employer is not around, you don't do all these kind of things. But when he or she is around, that is when you you are very serious with your work. That is when you are saying, oh, you go and do this one, you go and do this one. But when he or she is not around, you don't do all these things. So these are one of the reasons. These are some of the things that you can see, that you can know this person is trying to play to the advantage of others.
I understand you manage a team where you work. How can you identify who is office politicking and who is not amongst your team?
Okay, so just like I said, you are from the low level, it is something that you can know. So for example, in all organizations, no matter how big or no matter how small they are, you are always divided into a team. So the first access to use your team lead or your team leader, anyhow you call it. So when you have work to do and you are told to do this work, without the supervision of like your supervisor or your employer, you are going to do it without any or no rank. But when you are told to do something, you are not doing it. But when, like, let's say like an higher person is in play now, or like the CEO is around, that is when you now know that, oh, the work you've not done for like 2 or 3 days, you want to do it within 2 or 3 hours, so that the person will know, oh, you are working. But when you are not trying to like play into the book, or you are not trying to like play office politics, whenever you are told to do something, you are going to do it diligently and do it very well.
Has there been any time in your professional career, be very objective because our audience will want to learn this from you, where you have been involved in this?
Like I personally?
Yeah, let me put you on the spot.
Okay, so like I think when it comes to office politics, it's not something that you yourself can answer. It is something that people around you can answer for you. Because if you say you want to be truthful, you can't be truthful to yourself. It's not even possible. So it is people around you that will know, oh, this person is trying to like play to the book, or this person is just working diligently without any ulterior motive.
So what would be your advice to people? Whether are you saying office politicking is something worthy, or it is not? If it is not, if it is, tell why. If it is not, briefly explain why they should not involve in office politicking.
Okay, so like everything we are doing in this world, it always have advantage and disadvantage. But when we see that this disadvantage outweigh the advantage, then it is a bad thing. So from my own end, I think the disadvantage of office politics outweigh the advantage. So I will advise nobody to play office politics, and I have my reasons for saying it.
What are your reasons? 1 or 2, please.
Okay, sir. So when we say office politics has a lot of damages that it does to an organization. So one of it is damage to trust. So for example, now if I have a colleague that is playing office politics, maybe we are doing like, let's say, a group work, and because the person wants to be seen or something, you prove yourself as if you are the only one that does that work, and at the end of the day you are praised alone. Like it is a group work, but you take all the credit for it. Those other people that are your colleagues will not trust you again, because that's damage the trust they have for you. So that's one of the reasons why office politics is bad. So another reason is also like increased stress and anxiety. So what is anxiety? Anxiety is when you are anxious, when you don't know what is coming, because you know that, oh, at the end of the day, if you do this job, you are not going to like be praised for it. Another person is going to take the credit for it. So you have this increased anxiety within you that, should I do it or should I not do it? And at the end of the day, it is affecting the organization as a whole. And also too is reduced job satisfaction. So like for every person, like every employee, one of the things that you really enjoy at work is like when you work, you are satisfied with the job you are doing. This is what we call like office culture. So if at the end of the day, where you are working, you are not satisfied because of politics that are being played around, you are in like, let's say, the mini caucus. So at the end of the day, you won't enjoy the work you are doing. And when you don't enjoy the work you are doing, the organization as a whole is lacking. So if all these things are being put together, at the end of the day, it's going to affect the organization. So like, let's say the revenue that the organization is meant to generate, it will reduce because people are not working the way they are meant to work. So many things are going to be affected.
Thank you, Gogo. Thank you very much for your insightful contribution. And I think our audience has learned this, whether as the owner of the business or employee in the business. We cannot totally eradicate office politicking, right? Because there is the need for there to be a firm control in every organizational setting, right? But positive office politicking is what I subscribe to. Attitude or conduct that would together or collectively improve us as a firm is what I subscribe to. And even as an employee, I think everything that will enhance your professional competence, it's what you should also subscribe to, what any area of conduct or form of conduct that brings your fellow colleagues down, ridicule them, make them less relevant in the system, should be discouraged. Thank you very much for that insightful contribution. Without wasting time, please, for our audience, kindly note your questions and indicate when you wish to either make contributions or ask your question. But while we await that, I'd like to remind everyone that this episode is actually anchored by KCP. We have identified a unique need in the practice, and we are trying as much as possible with your cooperation to bridging this gap and together make accounting practice proud. Another aspect of the things we need to schedule to talking about today is IAS 12. Accounting for income tax. To join me in discussing that, it's Adeleke. Adeleke, are you here?
Oh yes, good evening, sir. I'm here.
Yeah. Adeleke will be speaking on specific areas of income tax, IAS 12. But what does this really mean? Why is this very relevant to us as in practice? On many occasions, I remember while I was in training, the conduct that I knew about making tax provision is after you must have ascertained your profit before tax, just do a 30% of that profit before tax and deduct it from the profit before tax to getting your profit after tax. That was what I was used to then. But after having gone through IAS 12, I was able to verify that is a wrong practice. So to put clarity to that, Adeleke, briefly explain the expectation of IAS 12 when it comes to preparation of financial statements.
Okay, thank you. So IAS 12, International Accounting Standard number 12, talks about income taxes, and it provides guidance on accounting treatment of income taxes, and it addresses both current and deferred tax. We'll get to that part shortly. But then the reason why this is important, IAS 12 is important, is because taxes are being regulated based on the tax law enacted in the jurisdiction where the company operates. So, of course, the tax law stipulates the tax rates that should be applied, which is what we explained to understanding. But it doesn't just stop there. There are other adjustments that are being made by the tax. We usually call it what the taxman recognizes. So there are some things whereby the taxman recognizes that is being treated or there is room to be treated differently when it comes to the accounting, following the accounting standard in preparing and presenting the financial statements.
Let me hold you there. Sorry, I had to cut you because I want to. This is something very, very topical and of interest to everyone. So I want to put a little structure around that. Truly, you have established that irrespective of the country where you are preparing the financial statement or where the company is resident, as long as the country has adopted IFRS, they need to strictly adhere to IAS 12. Am I right? That is what you say?
Okay. Yes.
Good. You've also been able to point it out indirectly that the application of IAS 12 has to be influenced by the laws, the tax laws in that country. Is that correct?
Yes, exactly.
Okay, that means that I'm just trying to outline this so that for the benefit of our listeners, that means that IAS 12 in its own does not prescribe how we will calculate tax. Am I correct?
No, it doesn't.
Good. But rather, it draws your attention to components of your tax expense And for you to calculating that, you need to understand, one, which country are you reporting from and what does the law in that country states. So for example, what it implies is if I am reporting for a company that is based in Ghana, right, and I want to apply IAS 12, I need to understand what IAS 12 has said, but for me to make that tax provisioning, I will need a better understanding of the local tax laws that is applicable in Ghana. Same thing if it were to be in Nigeria, if it were to be in Cameroon or any other country of interest per time. Thank you very much. But more importantly, IAS 12 actually classified that component of that tax expense into two. What are they?
Yes, so it's classified into the current tax and then the deferred tax.
Okay, tell us briefly, can you differentiate between the two? What is current and what is deferred?
So what we mean by current is your current year obligation, that is what you are required to pay. After you have followed the provisions of the law in calculating what the company is exposed to, what you arrive at is called the current tax.
There is usually this misconception, right? There is usually this misconception that your current tax, right, includes what specific forms of taxes. I need you to specify them so that our listeners can actually learn from that.
So, can I get a question again?
You said IAS 12 says the two components are current and deferred, right?
Yes.
Good. And you said earlier on that in applying this standard, you need to understand the local tax law. Is that correct?
Yes,
good.
Correct.
Let's use Nigeria as a case study. When I say I am estimating my current tax component of tax expense, what exactly am I referring to?
Okay, yeah, referring to the income tax of the company. That's what you're referring to this time around.
Okay, so briefly explain that one further.
Okay, so the income tax is a tax that is chargeable to the income of the profits of the company during that year. So we have various types of tax. You have the company income tax, you have the value-added tax, you have the withholding, which is not actually a tax or advance payment. So we have various taxes, but the income tax is specifically for the benefits that the company has derived in the country where it's allowed to operate. For the country to create a good environment for that company to make that profit, it is to pay a certain percentage of that profit that has been earned from that lucrative business environment that has been created for it back to the government as their tax.
Thank you, Adeleke. But because this is very, very germane and I've seen a lot of knowledge gap in this, so I want you to help our listeners to understanding this context very well. When you are prepared, you know that in most countries, the business structure is usually, that is, if you are registering a business if you are registering a company or an entity for business purpose, it's either you register it as an incorporated entity, or you register it as a partnership business, or you register it as a sole proprietorship business or an NGO. Mm-hmm. Are you there?
Yes.
If you are preparing the account of an NGO, what will be the component of the tax expense?
So an NGO, non-governmental organization, the component of the tax expense for an NGO would include the not the company income tax now, the value-added tax.
No. You don't get my point. My point is, when you are preparing the account of a non-for-profit making organization, right? Usually they will not even have profit before tax because they are not established for tax purpose.
Yes.
Do you understand? So what you definitely will have had will be the surplus, right? So what I want everybody to take note here is that after the surplus, there won't be any tax expense at all because that organization or that form of business is not obligated to paying corporate taxes, right?
Yes.
But in practice, I have seen instances where you have an organization of that sort and they are liable to paying taxes. What could have happened? Do you have any idea? It's not a crime.
Okay, yes, I understand your question now. So, so the non-governmental organizations, cases where they may be exposed to taxes are one, when they decide to carry out businesses outside what they are registered to do. In such cases, such income that are derived from such places are expected to be taxed.
Absolutely correct.
Yeah. Another obligation that they will have regarding tax is based on their activities. Wherever there is a withholding tax that is to be deducted from any of the people they interact with, they are also expected to deduct the withholding tax and remit on behalf of the...
Let's not even consider that one. I want everyone to understand that context of current component. Please, for the benefit of our audience too, we need to take note that for you to contextually understand IAS 12, you need to understand the tax framework of the reporting jurisdiction. For example, in Nigeria, there are several categories of taxes that are collectible, right? Some of these taxes are taxes on the income of a business entity, while some of these taxes are taxes that are as a result of the tax agency responsibility of the business. For example, when a company remits payee, it is not a company that is paying the payee, rather it is acting on behalf of the government to deducting that form of taxes that accrues on the income paid to its own staff, right? Another form of tax agency responsibility is the charging of with value-added taxes, VAT, right? That is also not an income tax. It is not a tax that the organization bears on its own. Rather, it is acting on behalf of the government. So, what you then need to understand is for you to determine what component of tax, right, will appear as tax expense after the profit before tax, right, must be taxes that are related to a component of the income made by the organization, not the ones as a result of its tax agency responsibility. So in specific terms now, the component of your income tax, of your tax expense for IAS 12 purposes will not include the payee that the organization has paid on behalf of the staff, will not include the value-added tax that the organization has charged on behalf of the government, will not include the withholding taxes that the organization has charged on behalf of the government in relation to those people that it has dealt with, right? But what are the forms of taxes that will be there? You will have the company income tax, of course, and why? It is because the company income tax is directly attributable to the profit the organization has made. In other words, the organization is bearing the tax burden itself, not the one it is acting as an agent, right? Education tax, as the case may be in Nigeria, it is a tax burden directly on the organization. Therefore, it will also form part of the component of the income tax, of the current tax. In some instances, you could have CGT, capital gain tax, because you could have made some profits that are not liable under the company income tax, but are liable under the capital gain tax. So in a very rare instance, you could have instances where, or situation where CGT could also be a component of your current tax. Then, depending on the sectorial legislation, there are some levies that may be attributable to specific industries. Say, for example, NITDA. So, where an organization is also liable to that, it could be recognized as a component of the current tax. Where the organization is, for any reason, liable to the recent police trust fund, it could be mapped as that, depending on what the preparer of the financial statement so decides to do. I want to believe that is well understood, but if you have any question in that very regard, please feel free to ask. Adeleke, back to you. We have just been able to address one out of the two components of the income tax in line with IAS 12, right? Would you like to explain briefly, very briefly, situations that give rise to deferred tax? What does deferred tax actually mean, and what could give rise to it?
So, deferred tax, they are the words that are coined, they are deferred and then they are taxes. So they are part of the there are taxes that they are not to be paid in the current year. They are they relate to the future period. So what I mean by this is because of the difference in the way the tax guys, which is the tax laws, see some transactions, which is one reason, and the way the accountants treat it brings about what we call a temporary difference. That is, I like to use depreciation as an example. A tax person wants to depreciate an asset for 10% every year for 10 years over the useful life of the asset, while the taxman does not want any form of estimation or per se, and decides to give what we call capital allowance in lieu of that, which is a structured way in which that the particular country decides to depreciate the assets. So that temporary difference brings about a timing difference in when a particular tax is due. That what brings about what we call deferred tax. That is, and the deferred tax can either be a taxable temporary difference.
Hold on first. Let's iron that very issue very, very well. I remember, please, everyone listening to this, I remember there was a year a financial statement was prepared for an organization, right? And remember we said the component of the tax expense is two: the current and the deferred. We've established the fact that the current is usually because of the fact that the tax laws in that nation says or are specified that certain profit is taxable, and by virtue of that you have estimated those taxes in line with what the law provides, right? And you have ascertained what is due, right? And a typical example, just as I explained earlier on, is the CIT, the EDT, and every other levies. In some cases, the CGT, right? The deferred tax component of it is not really a tax payable, right? But IAS 12 only recommends that we make provision for it because of certain divergence in the line of thought and reasoning of a tax person and a financial accountant. And I'd like to give you the reason for this. For example, when an accountant acquires an asset, a PPE, and it uses it for the business, the intention is that I need to make provision for the replacement of these assets. Therefore, I will be accounting for what portion of the year, what proportion of the assets that have been used up per year, which we call depreciation in line with what IAS 16 expects us to do it, right? But a tax man does not think that way. Our tax law does not recognize it that way. Rather, our tax law, especially in Nigeria, recognizes the fact that for any business to run efficiently, for it to run profitably, it's possible it will incur some expenditure. Some of these expenditures are recurrent in nature, right? Revenue in nature. Some of them are capital in nature. Those ones that are capital in nature, it calls them qualifying capital expenditure, right? If it's capital in nature and it is not qualifying, what it means is that the tax law will not recognize a compensation that is due for qualifying capital expenditure, but rather tells you how elsewhere you will treat it. And a typical example of that is research and development. Many organizations will see research cost as a capital cost, but the tax law says no in Nigeria. This does not qualify as a capital expenditure, even though it may be capital intensive, right? It then tells you when you incur a cost that doesn't qualify as qualifying capital expenditure, we will recognize it and allow you to expense it in that very year, right? But the ones that are qualifying capital expenditure, the tax law wants to compensate. Look at the intention. The intention in accounting is that I want to replace. Therefore, I should be setting aside certain portion of the value of that asset that I've used up. But that was not the intention of the tax law. The intention of the tax law is I want to compensate you for having taken a giant stride to acquiring more assets that will make you to be more profitable and by extension paying more taxes. Therefore, the intention is to refund that capital costs. Therefore, because the intention of these two schools of thoughts, the financial accountant and the tax accountant, are divergent. Because their intentions are different, therefore, sometimes it could create a difference. Sometimes it could create a difference, right? Now, this difference, and sometimes they may also align. For example, I incur an amount as fuel or transportation. The financial accountant see it as an expenses. The tax man will only ask you, are you sure you use that very sum for the business? If it's for the business, then it will also allow it. That means that in that instance, they align. But there are instances where the position taken by a financial accountant is not the same taken by the tax accountant. Therefore, that could cause a difference, right? That difference may be permanent in nature. Adeleke, I will expect you to explain that later on. I won't explain it. That difference may be permanent in nature, and sometimes it may be temporary in nature, right? Adeleke, would you like to take it up from there? You've rightly established the fact that there will be difference, and I've just been able to help our listeners to understand what is the thinking behind or what gives rise to that differences, right? This difference can be permanent in nature and can be temporary in nature. Would you like to, with examples, give instances that will result to permanent difference or a temporary difference? Is that here?
Yes, so instances that will bring about a temporary difference can be like the asset acquisition, acquiring a capital asset, like we mentioned earlier, because although their intentions are different, like you have clearly mentioned, both of them would, at the end of the day, give provision for that particular buying that particular asset. So although the amount they may be recognizing in a particular year may be different, in future they will align at a certain point in time. So that's what makes it temporary. But there are some differences that are permanent. That is, the taxman does not recognize it now, and he will never recognize it. So such are ones that are categorized as a permanent difference, which would, which are not now deferred tax now, because it has to be written off in that particular year, because it cannot be recouped in future. And an example for that could be donation to some specific places which is not going to be recognized by the tax person. If the accountant has taken that as an expense and the taxman does not take that as an expense, so that has to be expensed in that year, and there is that difference is permanent, and there is nothing. So that's it. Cool. Are you still with us?
Thank you very much.
Okay, so while we are waiting for call, let me just give further examples to the temporary difference. So we have instances where there is interest revenue, and we know in accounting, or we've established in accounting that they are recorded based on when it is due and not when it is paid. But when it comes to the taxman, he sees it, he only recognizes it when it has been paid. So that way, there's a difference in the timing of the recognition. But that is now its temporary difference, because by the time it is actually now realized and being paid for, the taxman is also going to recognize it, which makes both of them align at the end of the day. And that's what makes it a temporary difference. Okay, so while we're still waiting for Cole to join us, let me just talk. Can anyone hear me? Let me confirm if it's not my own network that is bad right now.
Yes, I can hear you. I can.
Oh, okay. Okay, thank you. Yes, so I just want to establish some key definitions or terms or things that we should understand while we're discussing IAS 12. So we've been saying carrying amounts. I would like to clarify that carrying amount is of an asset or a liability is the amount that is recognized in the balance sheet in the financial statement. So that amount we see in the balance sheet for our assets or our liability, that is what is termed as the carrying amount. Then we have the tax base. Tax base is what is the assets or liability that is attributable for tax purpose. So let me also use an asset for an example now. Carrying amounts of a motor vehicle is what you would see on the face of the financial statement. But when it comes to the tax base, it is what you see as the tax written down value in the capital allowance computation. So tax receivable value is what is the tax base. That's what has been calculated in tax as a value as at that date. But for the accountants is what is in the what has been calculated based on depreciation and is shown as a carrying amount on the balance sheet at that date. So this temporary difference that we are talking about, it can either be a deductible temporary difference or a taxable temporary difference. By deductible, we mean that it will reduce our future liability, while as a taxable temporary difference, it is a liability to us. That is, we are going to pay taxes on it in future. I don't think I've explained that clearly, but with time I'll get there. So the deductible taxable difference, this leads to a deferred tax asset. We refer to it as assets because it is and when it is probable that the company will generate sufficient tax profits in the future to utilize the deductible tax temporary difference. So it is only recognized as an asset when it is probable that the company will be able to generate sufficient taxable profits in future. That is when we'll see it as an asset. But if, for example, the company does not see itself generating sufficient amount profits in future to utilize that amount, then it is not going to be regarded as an asset. So, Luanime, is there anything you want to add pending the time Cole joins us?
Oh, okay. Well, not exactly, because I had a bit of network issue also from my own end. All right. Depending when he comes back, because I'm sure he might have some other contribution or question to that. Let's move to the next.
Hello, Tom, if you can hear me?
Yes, sir, we can.
Yeah, I'm so sorry. The network has not been so good in this part of the country. But it's fine. We can quickly go on. Adeleke, are you still there?
Oh, yes, I'm still there.
Okay. You're trying to make a point then before I had issue with my network. Can you just wrap that up? Yeah.
Oh, okay. I'm not sure when you stopped, when you disconnected. So can you tell me?
Yeah, I want to be double sure in my absence to be able to clarify the reasoning around temporary difference and permanent difference.
Oh, okay. Yes.
Okay.
Yes. Should I go on?
Yeah. So to manage our time, let me just hold you a little bit on that and quickly, I'll definitely come back to you and quickly bring on the spot again one other area that we want to speak on today. For the benefit of those who joined us after this must have started, please do not forget that this is an episode anchored by KCP. KCP is a firm of professional accountants, right? We've just identified the need for us to brainstorm together and bring do the practice proud. That is one of the main reasons for bringing this up. We have done quite a number. We have spoken on quite a number of topics. It will do you good if you create time to just rub your mind on some of those contents we have written on and the ones we have also done in a recorded version. For the ones we have written on, it's available on our LinkedIn. And for the ones that we have a recorded version is on our YouTube page, please do create time to reviewing that. But to
Hello, sir. Can you hear me? I'm guessing there's a bit of network issue again. So if I'm correct, I'm guessing Paul is about to call up the next speaker, or will I say person to present the topic for discussion, and then that would be auditing. Hello, Paul, can you hear me? Okay, so pending when Paul comes back in, I would like to call up Olamileko to take us on ISA 540. If I'm correct. Cousin, are you there? I'm not confirmed. Cousin, are you there? Can you hear me?
Yes, I can hear you clearly.
Oh, okay. So, for ISA 540, can you just give us a brief introduction first?
Oh, okay, yeah. Thank you so much. My name is Kozim Olamileko. We are looking at ISA 540 auditing, accounting, estimates, and related disclosures. This topic is a very important issue in the accounting space, that is the accounting estimates. So from the word estimate, accounting estimates to be precise, what do we mean by accounting estimates when we say accounting estimates? Because it is more of an accounting issue than before it comes to auditing. So when we talk about accounting estimates, we are looking at when an item of the financial statements cannot be precisely determined, right? So that's what's brought about the estimates. So most accounting estimates are related to the future. So that means it is an occurrence that tends to happen in the future, in which we cannot at the moment predetermine or accurately say what's the actual figure should look like. That is why we call it an estimate. So an estimate which would be more after when the actual events occur, or it could also be less after when the actual events occur. So let's look at some few accounting estimates that we are probably familiar with. So let's look at what we call the bad debts. So when we say provision for bad debts. So a provision for bad debt is more like you as a business owner, or from the company point of view, or from any organization perspective, you are looking at making a provision for bad debts out of your receivable, what we can call receivable, that is out of your debtors. You are looking at the pool of your debt account, that is your receivable, and you're saying that, okay, based on your past knowledge about the client in specific, or due to the industry information, you are estimating that some portion of your receivable, which is part of your debt, that will not be collectible, that is, you will not be able to collect it in the future. You make the estimate. Say, for instance, for simplicity, for the sake of this class, we could say, for the sake of this session, we could say that 20% of your receivable, you make a provision saying that 20% of your receivable will not be collectible. That is, you'll not be able to recover it. That's an estimate. When that period actually comes, says the following year, it could even be that you are able to, recover 99% or say 95% or something that deviates from the 20% provision that you made earlier. So that's an example of estimate. Another estimate could be seen in terms of warranty obligations. So we are quite familiar with this. When you purchase a phone, say from the slot, or you purchase a phone from whatever brands, you see they'll give you what they call warranty. So the warranty is covering, saying that okay, if there is any unusual damage to this particular mobile phone, you'll be covered in times of putting that phone back into its normal state. Which simply means that, say for instance, there is an unusual damage that is not as a result of you or causing such damage. So that warranty, the company will have make an estimate that okay, if you sell 1,000 phones, there's an estimate that out of the 1,000 revenue, out of the revenue that we generated from this 1,000 phones, say for instance now, we are going to be incurring warranty, expenses, say in the following year or subsequent year, probably say 5% or 7% or so. So we have so many instances whereby the estimates that the company are projected that they are going to incur, say for instance, in case of phone that we are citing, you could say that okay, 10% of the revenue you generated from such mobile phones, it will go for warranty. So at the end of that particular year, you will notice that it could be more or less, but you make sure you have an estimate in the current period so that you'll be caught unaware. So basically, that's an overview of what accounting estimates is basically. So when we look at it from the audit perspective, I don't know if you want me to proceed from the audit perspective.
Yeah, you can go ahead, cousin. Please go ahead.
Okay, so now an auditor they usually say when accounting ends, that's when audit begins. So an accountant in an organization or in any capacity will have done its own job, that is the management, the accountants, will have done the management to come up with this estimate. I'm using a familiar accounting estimate for the sake of non-accountants amongst us so that we'll be able to relate. Okay, as I cited an example earlier that let's say a 10% warranty expense has already been allocated for the following year by the company in this current year. They are making a projection in that regard. So now an auditor will now come in, like we carry on a procedure in order to ensure that this particular estimate that the organization or the accountant has already made, right? Is it right? What are the basis of coming up with this kind of percentage? So usually there are so many factors that we need to take into consideration. So we call it risk assessment procedure or related activity. So how is the auditor will be able to assess risk? Or say risk in audit, that is anything that would make the financial statement not show its fair value, that is being biased. So what procedure that the auditor is going to carry out in order to know that okay, this particular estimate that is being provided by the management of the company is actually accurate and fair and not subjected to biasness or its likes. So the major observation is that we need to look at the entity's environment. When we say entity environment, the company in question in terms of its business environment, in terms of its regulatory environment and its likes. So we are talking about automobiles in phone in this regard now. From the environment, from the entity's environment, they will have a past experience relating to phone warranty, maybe due to their previous product, right? So we need to look at the basis at which the management come up with this estimate in terms of looking at their own environment and see or to ensure that that particular estimate actually conform to, the past, why they actually were looking at the future. So another requirement would be the financial reporting relating to such estimates. There are some accounting estimates that is being, captured by IFRS, International Financial Reporting Standard. A good example of that is IFRS 9, which is related to financial instruments. Quite a number of us may not know what IFRS 9 is. So IFRS 9 is the standard that talks about, how to deal with financial instruments. That's a topic on its own. So, another factor is regulatory factors. So before the CBN actually adopts, the usage of IFRS 9 and its likes for financial institutions, in order for them to, recognize, their financial instruments in terms of their, loan receivables, and they're making provision for bad debt. I would say bad debt in this case, which is the expected credit loss. Before, there is a regulatory pronouncement by the CBN that actually give a step-by-step guideline for them to make such an estimate. So if an auditor is coming in to audit such an estimate in this instance now, an auditor will be relying and falling back on the regulatory guideline to see if the company has actually followed the regulatory guideline by the CBN in order to account for their estimates. And we usually know there's something that is common not only to accounting practice. Whenever international law or international authority or its likes is conflicting with the local regulation, local regulation will usually supersede, most especially in the case of accounting space. So if there's a conflict in international regulation, say international financial reporting standard, and the local regulation will supersede. So which is what the auditor will be looking at in this regard. So
I want to ask a question. So in some of the instances that you mentioned, what then happens in a case where there are two companies, right, in the same industry, in the same field, but they've applied or made different estimates on similar transactions or assertions? What can the auditor do in such a case?
Okay, yeah, thank you so much, Oluwani. So if we look at two industry in two different companies in the same industry, when we want to determine accounting estimates, although we look at the industry, which is part of the entity's environment, the industry in which the entity operates, but we usually also look at company specific. Aside from industry, we look at what is called company specific. Say for instance now, it may be general that the industry average for what's it called? It is maybe what you cited now that for this particular industry, this is what is usually obtainable in that industry. But there are so many factors that will warrant the company using another estimate that is different from what is obtainable in that industry if there is an occurrence or an event that is specifically or that is related to them only, right? So another thing is that we have what we call point estimate range. At times they might not use the same estimate, but it might be very, very close, right? So if it is very close, we will not be able to have a material, we'll not be able to, there will not be a material risk in that regard because it is within the points range. I don't know if that addresses your question.
Yes, it does. Yes, it does. I just wanted us to put it out there for people that might be thinking, like say for example, we have let me use MTN and Glo for example. They are operating in the same industry, right? So there might be specific conditions, right? Maybe to Glo that will warrant them having a different estimate, even on the same assertion or on the same item, different from that of MTN. So I just wanted, because those are kind of the questions that might pop up in someone's mind in regards to the accounting estimates. Is there any other thing you'd like to add before we move on to the next person?
Okay, yeah. Basically, I've already, introduced what accounting estimates is and the impact on the financial statements. So, also we can look at further example of accounting estimates, because people usually believe that whenever you hear accounting estimate is usually related to maybe property, plants and equipment and its likes or receivable. So we can have an accounting estimate that is even spilling over, that is captured by an accounting standard. We have what we call, outcome of a pending litigation. When you have a litigation that relates to a particular period, say for instance, the company is having a litigation, a court case. Let's say the company is in the food industry, and one of its customer, complain of having an hazardous situation as a result of consumption of the company's products. If such litigation occurred in a particular period, then it will then mean that they won't be able to ascertain whether or not that particular litigation will be in the favor of the company or it will go otherwise. So the company, through its lawyer and an accounting standard that actually captured that entirely, we are not looking at that. We should be able to come up with an estimate that, okay, at what this is, or at on average, to be precise, this is what the outcome of the litigation would be should it be against a company. So what the standard actually talk about, let me just talk about what the standard also say briefly, is how do we identify and assess risk of material misstatement, and when we actually assess this risk, how do we respond to it? So for the sake of the non-accountants among us, where we still assessing risk of material misstatement, right? There are two words there that might sound strange. We have materiality, then we have misstatements. We all know that in a layman language, materiality, that is something will be material. An item in the financial statement will become material if its omission or obstruction will affect the economic decision of its users, right? So we also have misstatements. Misstatements simply means that having incorrect information being presented. When you want to speak in a layman language, that when we present incorrectly in the financial statements, that can be confusing. That is a misstatement, right? So all of this identification will still boil down to we trying to look at the degree at which the estimates will affect the financial statement, right?
Sorry, cousin. Zaina, please, can you mute your mic?
Yeah, sorry, can you guys hear me?
Yeah. Yes, sir.
Okay, good. Thank you for holding on while I was not there. Cousin, thank you for the justice you have also done. But I think at this junction, we need to leave, just pause a little bit. Let's give the audience the opportunity to ask some questions. Is there anybody in the house that has, based on what we have discussed thus far, has any area that desires clarification? Please indicate. Is there anyone that has any area they wish to clarify? Anyone? Okay, I think Bukola Abigail wants to ask a question. Please, you have the floor, please.
Good evening, sir. Thank you very much for this section. Yes, my question is, how then do tax analysts and fine accountants settle the disagreement of their records, especially when it comes to paying tax and all that? Is there like a way they come together to avoid misunderstanding?
Okay, financial analysis is a different discipline entirely. even though in recent job adverts, they have always been publicizing financial analyst role and giving an outline of job description of a regular financial accountant, right? But in my view, there would not be any area of alignment if you are to discharge your responsibility as a financial analyst. You have no responsibility to taxes, right? That is not amongst your deliverables, right? So obviously, it is expected that if you are in a practice and you have a line of practice that does not really align with what your competency is, the ideal thing is to respect the opinion of those who have competencies in that very area. Do you understand? However, see me as a financial analyst today and approaching you that, oh, I'm not agreeing with certain numbers in your provisioning, right? What is expected of you as the tax advisor is to enlighten me, and also not just to tell me that, oh, this is what the number says, right? Or this is what the number should be, but you should be able to reference your position, right? Your estimates to what the law has referenced or stipulated, and every other guidance that is relevant to that topic of estimation. I hope you understand. But by and large, a financial analyst, calling a financial analyst, will rather be involved in all of its financial analysis responsibility, not including taxes, right? And if at any time you need to make reference to any tax estimate, you have to entirely rely on whatsoever the supposed tax consultant has estimated. Is that clear?
Yes, it is. Thank you very much, sir.
Any other question in the house? Is there anything that we have explained thus far that you desire further clarification on? Or is there any contribution you wish to make in? Anyone? Anyone? All right. So while we expect more to come, let me quickly jump back at Cousin. Cousin, are you there? Cousin, are you there? Indicate if you are there. Just want to be double sure your network is stable. While I'm expecting feedback from Cousin, Adeleke, are you there?
Oh, yes, I'm here.
Okay, Adeleke, remember that in our last discussion, we stopped at differentiating between the permanent difference and the temporary difference, right?
Yes.
And we eventually concluded that permanent difference are never reversible, right? Those line of thoughts of the accountant and that of the tax consultant are at variance and they will never reverse. And you did give an example on whether a grant or a donation is tax deductible or not, right?
Yes.
Yeah. On the other side, which is what actually will impact on your deferred tax provisioning, is the temporary difference. So that temporary difference, you will also agree with me that in that instances, the accountant's position or line of thought and that of the tax consultant are only different in a short term. Situation will happen later on that will make that positioning to reverse, right? And the impact of that reversal may result to what we call deferred tax asset or deferred tax liability. For enlightenment purpose, can you enlighten our listeners on what we mean by deferred tax assets and deferred tax liability.
Okay. So what also mean by deferred tax liability is the amount of income taxes that is payable in future periods in respect of the temporary of a taxable temporary difference. Like we've mentioned, there's only a time the time when we say temporary, just because of the timing. Eventually they will align. But what now makes it a liability is if the amount will be payable. But then on the flip side, if the amount is going to be recoverable in future periods, that is, you are paying it now to recover it in future, that is called a deferred tax asset. And what can lead to a deferred tax asset would be a deductible temporary difference. When I say deductible, it means you can deduct it. What's it called? You can deduct. Okay, I think an example will better portray that, but I'll come to the example. Another thing that can lead to a deferred tax asset would be the carrying forward of unused tax losses. So if there is loss in a particular period and is going to be recovered in future, like since when the tax is going to be completed in future, you can now recover it based on the provisions of the tax law. That way that there is a temporary difference. Once the company can make enough profit, they can now then claim that amount. So it's obvious how that one is an asset to the company. And one that really that also have can be the carry forward of unused tax losses and tax credits this time around. So coming back to the example of the deferred tax assets, using the carrying amount, let's say the depreciation we've used a higher percentage to calculate our depreciation this time around, which means you're having a very a lower carrying amount compared to what the tax person is saying. That is, the tax person has not given so much allowance to claim the deductions yet, but it's going to give it to you in future. So because it's going to give you that opportunity in future, it is an asset to you, because in future it becomes more like a relief for you. So that explains the deferred tax liability and then the deferred tax assets. Hello, Cole, are you with me?
Can you hear me?
Yes, I can hear you now.
Yeah. So one other area is what will be the impact of a deferred tax asset on the statement of profit or loss?
So on the statement of profit or loss, the impact of deferred so the deferred tax assets.
Okay, let me help you with that. I understand you are the core tax person. So Adeleke has been able to establish the fact that remember, we did say that deferred taxes does not necessarily mean you are paying additional taxes, right? But because of your matching concept, right, in line and also the Akura concept that says expenses or income that relate to a particular period must be matched or recognized in that particular period. Then because of that, deferred tax now emphasize that we had recognized a difference in the line of thought of a financial accountant and that of a tax accountant, which could impact what we will pay or recover in future. Hence, we need to book it today, right? Or we need to recover the income today, tax income today, such that our books will always reflect what it ought or what it should be, right? For the benefit of those who might still want to learn more about deferred taxes, I remember last year or 2 years ago, we did a content on deferred tax assets, the computation of itself. I've shared a link on the chat box. Just click on it after this session. It should take you to that very page where we stored that on our YouTube page. We did it in two phases. We have the practical approach to deferred taxes computation, part 1 and 2. So in that session, we actually took the audience through how to computing, right? Limited time will not avail us the opportunity to go into how the computation will be. But in line with the question I asked Adeleke, the impact of a deferred tax asset on the face of a profit or loss is that it will have a negative impact. Sorry, it will have a positive impact. You know, ordinarily, your tax expense is a negative figure to be deducted from your profit before tax, right? But in an instance when you are now seeing that tax expense, right, being positive, it means it must have resulted from a deferred tax asset that is in excess of the current tax, right, does giving rise to a positive figure as though you are making additional income. So that is why we call a deferred tax asset a tax recovery, right? But the impact of a deferred tax liability will be a negative on the face of the statement of profit or loss. That means we recognize that there will be or there could be a additional tax exposure in future, right? Therefore, we recognize it today, right? Such that our positions will reflect what it should reflect. Thank you so much, Adeleke. I don't know whether Alex is there. Within a few remaining minutes, let's quickly bring to speed what we have on financial reporting. Alex, are you there?
Yes, good evening.
Yeah, good evening, Alex. Alex will quickly take us through glance. Maybe we may not be able to go in depth today, but we'll still bring up this topic again, IFRS 18. Can you quickly, in a very concise way, explain to our audience the intent of IFRS 18?
Okay, good evening, everyone. So IFRS 18, you and me all know that IFRS 18 is a new international financial reporting standard that has just been introduced by the International Accounting Standard Board. And the sole essence is for transparency and comparability of the financial statement vis-a-vis with other entities. So, and the introduction of this standard is as a result of investors complaining or concern as regards they cannot compare one financial statement entity with another. So that was what led to the introduction of this standard. So what does the standard aim to achieve? Aims to respond to investors' demand for better information about companies' financial performance. It aims to improve transparency in the financial statement. It also gives investors a better basis for analyzing and comparing the company's performance. So those are just the aims of what the IFRS 18 aims to achieve. So there are other valid points that the IFRS 18 introduces based on the introduction of the IFRS 18. So IFRS 18 introduces two new defined subtotals and the way the classifications of the income and expenses are. So the defined subtotals are grouped into two. You have the operating profit or loss, and you have the profit or loss before financing and income taxes. Why? Based on the classification of income and expenses, they are grouped into three. Either you have the operating, you have the investing, you have the financing. So what does the operating profit or loss try to achieve? It tries to give the picture of the company's operation. That is, on the statement of profit or loss, the operating side that reveals the total operations of the business. It just wants to capture what is the financial picture of what's currently operating. That's then for the profit or loss before financing and income tax, tries to explain the company's performance before the effect of financing activities in the business. So there are some other aspects that we also introduced then, which are the enhancement of grouping of information, guidance towards the presentation of information in the primary financial statement, disclosures for items known as orders. There are some other ones, but for the sake of time, we have to stop here. Probably in the next class we can harp more on these various topics.
All right, Alex, thank you very much. I promise that we will bring this up again in our next episode. Time would not allow us to go much more in depth, but I believe in the little we have discussed thus far, you must have learned something. Don't forget, the intention is not to teach all of these things holistically here, but to open your eyes or draw your attention to areas relevant in practice that you might need to brush up, and if you have not been well equipped in those areas, and if you have been well equipped in those areas, further revise what you have learned about that. I believe you have learned something. Please, is there any question that you have, or is there any contribution from anybody? Please, let's hear from you. Any question? Any contribution? From any of our listeners, any question, any contribution, or any remark from anybody? Let's hear from you, please. Anyone? Temitope, do you want to say something? Let's hear your voice before we close the section for today. Temitope Rachel, are you there? Said, read one. Okay, Temitope wants to talk. Good.
I'm coming very, very late because I'm at work. So maybe in the next meeting I'll join.
All right, thank you very much. But you can watch the revised episode on it on our page. Said, do you want to say something? Thank you very much, Temitope.
Okay, yeah. Actually, apparently I'm on transit, but however, I just want to add to it that the activity has been impactful because it has served as a reminder on one or two things that we meant to have. And the other side of it has to do with the link you just shared. At least it's also a recall for those that are not really having those information at hand. It's a wonderful one. Thumbs up. And on behalf of all participants or listeners, great work. We appreciate you.
Thank you very much, Said. Thank you so much. Deborah, let's get one more contribution, then we will have a closing remark. Deborah, are you there? Deborah, do you want to say something? Deborah Odlide. I think Deborah is shy. Okay, so thank you very much, everyone. Let's get a closing remark from Adeleke first. What would you want to leave your audience with?
Okay, so what I'd like to conclude is saying that IAS provides a framework for a consistent and transparent reporting for our income taxes, and also aims to reflect the economic consequences on the financial statements. Then I also like to remind us that we have the current tax component and we have the deferred tax component, and remind us about the deferred tax. What leads to the deferred tax is the temporary difference between the carrying amount and the tax base. So so that was what I'd like us to take away from this session.
All right, thank you, Adeleke. I think somebody put up his or her hand. Luke, do you want to say something? Luke, I saw your hands up. Do you want to say something? Okay, maybe he or she is also shy. Thank you very much, Adeleke. Cousin, would you like to give your closing remark? Is Cousin there? Is he back? Okay, while we are waiting for Cousin, Oluwagogo, are you there? Gogo, are you there? What is wrong with network today? Okay, Alex, have the floor while we wait for the others.
Okay, good evening. So from my end, my conclusion remains that IFRS 18 for now is just a bit of awareness for us to start preparing our minds ahead of 2027, because that's when it's expected to be effective. We as financial people are supposed to get ready our minds, start reviewing our records ahead of 2027, applications, side effects. Do we need to arrange our chart of account for this purpose, just for the sake of your statement of profit or loss? This where I'll stop.
All right, thank you very much. I think Gogo is back. Gogo, are you there now?
Yes, sir.
All right, can we have your closing remark, please?
Okay, so my closing remark is that when it comes to office politics, we should make sure that we don't play politics that will pull our colleagues down. We should make sure that in everything that we do, we carry people along, and we make sure that we work towards the upliftment of the organization that we are in. Thank you very much.
Is Cousin back now? Okay, Cousin is not back. All right, so on to everyone who has attended today's session, we thank you. We appreciate your time. For those who might want to have more insight on what we have discussed today, it will always be available on our YouTube page, right? And I've also shared a link to the practical section we had on deferred tax, because I do know that is a very, very tricky area for most people in practice. And on all that we have discussed, try as much as possible to make other self-discoveries. We wish you all the very best. Try to use, if at all you should be involved in any office politics, do it in such a way that will brings about the upliftment of your team, development of your team members, and the development of the organization you are working with. I wish you all the very best. See you same time next month. Do enjoy the rest of the month, and safe trip back home for those who are still on their way home. Thank you. Good night.